Hi there, Alpha Team. You joined me here just pre-Super Bowl. I'm getting ready to sit down and watch that. I can already see on the Discord that there's a few people already shorting gold for the start of the weekly trading program. I'm going to talk about that in a minute. Very, very important week. So I'm going to change up the order of the preview. That hopefully will be with you quite early this week. We've changed a few bits of the logistics. So yeah, I do think it's going to be a very important week. What I'm going to do is discuss that. Then I'm going to do a quick review of last week, look at the data that's due out for the rest of the week, and I'm going to put up a page of the sort of ramblings that I've been marking down for my own kind of setting up of a plan, just to be on top institutionally, how you'd look at things, useful tidbits. There may not be any use to you, depends how you look at the markets, but it's just to show you how you might think from an institutional mindset. Then I've listed out all the speaker events for the week, and there's a preview of the diary right at the bottom. So, without further ado, I'm talking about Alan Hansen is in the room. So, apologies for any of you global people who don't know about UK football, but Alan Hansen was a bit of a legend for Liverpool. And then on Match of the Day, he was a pundit and he was famous for some of his sayings. And I'm saying this week is absolutely crucial in a Scottish accent. Because as my setups have been showing for the dollar, we're talking about topping out in that wave 2 setup before it finally has a little blowout to the downside. Indices have been walking the wall of worry. We've gone through that. We've done quite well out of it for the last couple of weeks. And there's a sense of nesting around. One or two people are picking up on that. And, we're about to get this whoosh moment if everything falls into place. We've got past that big hurdle on Friday, the US CPI benchmarking, which we'd highlighted for over a week. Gerard backed it up, kept reminding you towards the end, not on everyone's diary. And we're going to try and keep doing those things, get things out there for you that might not necessarily be on everyone else's list. We're trying to look after you. And obviously that came out okay. So as I mentioned throughout the preview piece, there's been a problem since COVID with the data, and the Fed have been all over the tapes saying that they don't trust the data. Waller didn't trust the data. A couple of others. There's another one of the guys from last week, which I'll remind myself of in a minute when we go down the page. And they said it would take them about 5 years to sort out the discrepancies. And since 20, we're well on advance to that. And that was really crucial on Friday to not miss. I think just for the whole confidence, it just takes a shoe out of the longer rates higher for longer dynamic. They can now talk and consider the data to be accurate in the short term, and that can only be to our benefit. So, like I said, we've been lucky. Gold itself, that's struggled to bounce off the bottom of the triangle, but it is still kind of within that. But it depends on how this data comes out on Tuesday. CPI this week is the actual CPI print is the most important, and I'm just the tea leaves and reading between the lines on a few of the people who've been bearish out there. They're scrambling around having to redraw their charts, and if they don't get the downside in today's session and through Tuesday, then it's tails in, I think, from them, and we're going to get this drive up, particularly on the indices. Subject to how CPI goes, then in the dollar, then that will obviously take care of commodities and your forex setups. Why is CPI going to be important this time? Well, it's one of those periods where, because inflation was so high last year, what happens is they call it the base effects, and those are about to drop out. So the effects can sometimes be much bigger than you'd normally expect. The Atlanta Fed have been banging on about the drops in rents, which aren't showing up in the normal services data. There's every chance that starts to show this month. So there is a very good chance we get a decent market positive print, a downside print to CPI. But if we don't, there's a number of setups on the charts which could really go either way. I mean, you can say that, well, why is he saying that? That can happen anytime. But no, we're set up for, for this breakout. And if not, then we might have to give up in the short term on some of this upside while we consolidate. So it's a potential trend changer. There's some people who watch long-term cycles, and we're right on the end of an opportunity to actually put in some consolidation. So it's the time frame I've been talking about for a number of weeks is that we're running out of road to get this dollar sell-off. So it almost feels like this week and this print in particular has a lot about it. We're all worried about the re-emergence of inflation. To say anything that surprises the upside, and it's going to be quite ouch, a sort of ouch feeling to the market. So that's how I think we are set up for this week. I still favour buying the dips if we do get the pullbacks, mainly because of what I'm going to reiterate again on the setups. So to start with the dollar, if we go back to why I feel it's coming off, the long-term setup, we had that 3 in place for the bottom of the market in October 22. And we've since put in this decent A wave and a B wave retracement. And from that, we've had a 5-wave move down, the 1. So we've been tracing out a consolidation ever since then, and then expecting to complete this 5-wave move down. The way we set up, we've already hit the, what have we ended up as? Just with over 0.5% of the retracement of this 1 leg down for the 2, and we're not far off a 0.618 retracement on the follow through. If it goes the wrong way, we'll look at that in a bit more detail in a minute. But there's every chance that the 2's topped out and then we resume the downside. But if not, this could be a connector here from what we had in as a 1. It could just be a connector and we end up doing a double correction for the B wave before we sell off. So it's big decision time this week for the dollar, I think. Show it there a little bit closer. So the 2 wave, I wouldn't like to see it go more than spot 618 from whatever we put it. Let's just take today as being the low. If that does happen to get some bad data Tuesday, I don't really want it to go through that 1 previous high of the B wave. It's totally valid that it can do and still sell off, but it just makes the whole picture a bit more complicated. So it'd be nice if we had that classic of the 1 wave, a small consolidation and a spot 618 before we come off. But ideally, we don't take out the current high that was in place a couple of weeks ago. So, looking at this on the hourly chart, we put in that area here, the 104.62. What we've got here is an equal legs of the A and C wave that I originally put in to be the wave 2. And it's also right slap bang in this range here of a spot 618 of the pullback from the B high. So it's an important level of confluence that you need to keep in touch. But obviously this area just down below, we've bounced off it 3 times now, 4 if you include the retracement back from what was a gap open a few weeks back at the start of February. So this is a key volume level that needs to be sorted out. It's highly likely that we do possibly test that before Tuesday. And if we do get a relative new low in, then again, that is a consolidation pattern in place that suggests we might have more upside to the dollar. So what we'd really like to see is a proper sell-off from here to show that what looks like a nest is going to the downside. So the dollar totally crucial here, and it's tough to make the call until we see a little bit of action post CPI, and really we need to know how good that data is in terms of our whole setup. We don't need any further pushback on rates. We don't need a return to inflation. It would be nice to get this shock print to downside and have some proper risk on for a few more weeks. The DAX, we talked about that again, meandering, lots of 1s and 2s. Would like to see it come down to the trend we put in last week. I still feel like that is the area that we get a bounce from. Gold, obviously people are talking about shorting it. We've got this triangle I've been talking about, and there's every chance that we've got a truncated finish here relative to that trend line. But it did feel like momentum was giving up a little bit last week, but that might just be a pause as we go into this crucial Tuesday. If we get it the right way, then it'll just blast through the upside of that triangle. But in the meantime, we'll probably fall back on the second most bullish setup, which is what we talked about on the weekly about a month ago. I presented 3 or 4 cases that are all valid for the medium-term upside, but the most bullish one is holding on to this initial pullback low from the all-time high at the start of December. It's around the 1973 level. We'd like that to hold, and if the current first wave down before we've had this meandering for the last couple of weeks, repeats itself, a 1-for-1 comes up just short of that test at 1979.80. That'd be another ideal setup before we blast off to the moon. It's another all-time pulling back ones and twos, another 1 and 2, classic nesting. So it's to me, it's either the triangle or that. But there are two other valid setups. One goes to 1920 and one 1810. I'd rather not be looking at that, but you can't rule it out. You've got to keep these alternatives in the back of your mind. But to me, I think we've still got this Q1 early part of Q2 rally coming for this market. Nasdaq wise, I was playing around in that on Friday, and it did look like someone was really trying to get that to an all-time high for the CFD, but 18,000 was held. Wouldn't be surprised to see that jump up. What is interesting is that there's a number of people, what we pointed out the other week, that there was some invalidation levels going on. That big level that we had in there at 17,464 just means that the waves extend. You can't have the third wave being the shortest wave. It's the classic first thing you go to. And when you got nest after nest, a big 1, 2, next level down 1 and 2, a 1 and 2. We've had a 1, 2, possibly 3, 4, 5. What starts happening now is you start very quickly, if we're right, getting dragged up into 3s, 4s, and 5s. Here, what looks like an obvious level of 4s all in a row where you're going to get retracements and keep us there for a good couple of months as a range. Be a 2,000 point range, but you'll have confidence of playing within that, and ultimately there's more upside to come. So be very careful with shorts, and if the dollar shows any signs of cracking this week, do not take on the Nasdaq 100 without really being all over your levels, because there's a lot of bears out there that are about to throw the towel in and start redrawing, suggesting they're going to start redrawing like I've already got in place. I've not moved anything since last week. This double 1 spot 618 here at 18,300 is a big target if we break 18,000 and hold it. So keep that in mind. Still lots of potential impulse and impetus to the upside. Light crude oil, again, is on the cusp of a move either way. It's difficult to know what's really in the ascendancy here, because we had the original 3-wave move to put in what was the B. We talked about it. The head and shoulders dropped to a new low. We've since rallied. That could be a connector before we sell off again, or equally, any signs of upside, any break of that previous B high, and it looks very much like we're going to put in at least what you'd call a 1-for-1 double consolidation. And it also still sits with that original 5-wave impetus from down here at the start of the trend channel we identified. That would be 1 spot 618, confluence again up here around the $83 mark. So I wouldn't rule that out as an ultimate thing. That was what we originally said, that given all the negatives or geopolitical risks that are around, that's where we should really have been targeting in the first place. It's only that we started to get this sell-off and repeat back to the channel that we gave up on that in the short term. So both of those are quite valid, and obviously it looks very much like this week is a decision point time. So that's all I really wanted to look at on the charts this week. As I said, I'm going to do a quick review of what happened last week to put us in this position. Quick look at what is out this week. Again, it's another busy week, not just the US CPI. And then I've done a little bit of, and I won't read it out particularly, but I'll just mention a few things, reasons why you should be looking at the markets the way that I am as a kind of at least one of your options, because it is there's a lot of information out there at the moment on the media services. Chatting to some quite cute people who've been waiting for one or two of these shoes to drop, and they're coming in. They seem to be coming in together at the minute. So last week we went into it saying post the NFP, and these are important things. You just want to write them down. Keep when you're setting up for the following week. And I mentioned it in my original introduction. Second derivatives of data. It's not just about the headlines. Get in there and amongst the detail. The NFP household report showed you that all the strength was coming through from the services read through. I mentioned it. Said expect that to come through in the ISM services. There'll be dollar strength. We got that. And then we talked about the US CPI benchmarking being the other important thing at the end of the week. Should have been in your calendar. It's not your fault if it wasn't, and your provider wasn't putting it there. We'll try and keep you abreast. Don't forget to check out our stuff. And as I flippantly say, if I'm annoying you watch the video. If you don't like me, print me out, put me on the dartboard and throw things at me. I don't mind. I can take it. It's happened for years. Little brief look at what happened in the States last week. There were a number of speakers. We'd highlighted them. To start with, Goolsby, we did a little funny on Twitter. He was a fence sitter. And Mester, she was definitely wanting to wait and see. Cash and Carry, Neil Kashkari. The work's not done. Susan Collins was a little bit more helpful. She said that not only is she looking at the inflation, but they have got a dual mandate. For maintaining full employment now is back on her radar for discussion. So that is quite influential. We see any drop down there, it's the Fed's excuse to go, then we've definitely got people making that part of the discussion. Patrick Harkey said he can see the runways in sight, but he's one of the first to say that the hikes were done. He's useful. We'll keep an eye on him because he's definitely on the dovish side. But then at the end of the week, we ran into a few more people on pushback. Kugler is watching consumer spending and credit cards. Well, there's some retail sales data out in the States this week, so have a chance to have a look. Susan Collins again watching housing inflation. So housing inflation and employment. Very supportive of patient approach is Tom Barkin. And then you had him again on Thursday night ahead of that CPI benchmarking, bemoaning the fact that the accuracy of economic data was on the Fed's mind. Well, there you go. You got it reiterated that they were worried about it and now they shouldn't be. So that was a big week. Powell started the week. This is how stupid the markets can be sometimes. The dollar supposedly caught a bid on the back of Powell's 60-minute show on Sunday night, but that was aired on Sunday, recorded on Thursday night, even before the upbeat jobs report. So it's in between his pushback on FOMC, nothing to change it. The non-farm payrolls pushed it through the roof. There was absolutely no chance it was going to rein in any of the "we're not going in March" nonsense. So all those headlines that came out of that should have all been in the price. Don't really understand why that caused such an issue, and it caused an issue for sterling during the week. Quite a bit of commentary during the week as well about politics. It's not really had much of an impact yet, but there's a bit of to and fro about Powell. If he lowers interest rates, then that's political, trying to support Democrats. Trump's on all over the airwaves saying that he won't put Powell back in, even though he was the one that brought him in the first place. And Powell's saying we've got no interest in playing politics. It's all about integrity. Never have done, never will do. So we'll see how that goes. But at least he did admit in that interview that they do regret not going earlier on the interest rates. They totally misread it. And again, they were mentioned that commercial real estate in that interview was okay, that they'd already seen issues and were all over it. So not surprisingly, that NYCB issue was pretty well contained and sort of suggests in the short term that issue is contained and we don't have to worry about it for now. As I said, the Fed had its Super Bowl night. They had their special fields team out during the week and knocking the ball as far as they can through the posts. There's no rate cut coming in the short term. S&P took out 5,000. I've already mentioned how the Nasdaq was on the verge of 18 on the CFD. The future did shoot through, but landmark week. Historically, these things don't often just touch them and come back. That touches on a point I did read about some people who have been very bearish, sort of quite concerned that this might be a blow off moment, that the markets do just go absolutely to sky. It doesn't happen very often. Normally you get blowouts in markets. You get those V-shaped sell-offs and recoveries when everyone's scared. There's more capitulation than everyone's steaming into market, but that seems to be happening at the moment. And if it gets any more encouragement, then watch out. ECB, they mentioned about commercial real estate risk, CRE, and if what they said this week that they're looking to enforce banks to have more capital to look after that, then that's a pseudo tightening. The way they sort that out normally is that they then ease the rates a little bit to balance it. So we'll take that as a potential positive going forward. UK, we talked about the housing tie-up between Barratt and Redrow, and on the same day that the Halifax House Price Index got off to a flyer with the January results. Hopefully that is a positive sign of industry and construction for the year ahead. but they did both pseudo put a profit warning through. So fingers crossed. But it's a positive alongside the global UK PMI print. So Sunak and Bailey et al. All had a good start to week with UK data last week. What else have we got coming up? Like I said, sterling struggled a little bit. The bets are coming off on Bank of England rate cuts for 24. They again are running out of room, but didn't really see much sterling strength come through there purely because it was being outperformed by the FOMC's dollar push. China started to see a lot of talk about capitulation around, possibly that being totally overdone now. Some are calling for stabilization funds, which kind of backs up what was suggested as a bailout the other week. And that used to be the plunge protection team in the US, no longer required. Maybe they can lend them. It's like I said, think of that as it's like the A team. Remember them? They had an acetylene torch in every barn that they got holed up in. Always managed to escape. No job too big to fix. And with Chinese deflation coming in at minus 0.08%, then things aren't looking too rosy over there. Royal Bank of Australia and the Bank of Canada both said the fight in inflation's not over, and the Aussies even said there might even be a further rate increase required. And geopolitics was all about where we're going to get that Hamas deal. They've come out with some rather strange requirements, which Israel have now turned down. So again, be careful. That oil setup may be driven by the geopolitics. Every chance we get a double bounce. So coming up this week, then we've got the Super Bowl. Who's going to win it? The Chiefs, 49ers, or has Taylor Swift already managed it? She's back from the tour. She's arrived, and like I said, I'm still gutted the Detroit Lions didn't make it. I like an underdog. Sheffield United, we're back in town. We won at the weekend. They'll come roaring back, the Lions. Don't worry about that. So it's US CPI and PPI. I've mentioned about how the read-through from last year could easily, and the potential rents falling could suddenly help this market out. Kugler's watching consumer spending. There's some of that on Thursday. US core retail sales number. And then you got some sentiment indices, the New York Empire, Philly Fed, and Michigan over the week. And even though it's not normally put down as anything interesting, we've been talking about the balance between the Fed's balance sheet, QT, QE, Q reversal, blah, blah, blah. We get some update on where they are on Friday. That may be, it's late after, and possibly some of it after Friday's session end, but it might be something that you'll see in the news wires going into the following week. UK full bag this week, unemployment, wage data, inflation data, GDP, retail sales, everything there. We'll really know where we are. Look out for sterling spikes, obviously. Europe, a little bit of CPI across the major countries, some industrial production. We've got German ZEW. I've mentioned that before. I always treated this as a secondary one after the IFO, but this is literally financial advisors. There's only about 1,000 in the survey, I think. Tend to all move like sheep in the same direction. We'll see what they're thinking about Europe. It'll be instructive more than anything else. Asia's got China on holiday. I think Japan possibly on holiday tonight. But they've got GDP and PPI later in the week. See if there's any clues of any tick up in pricing pressures. That's what we're looking for there. Australia, they've got inflation expectations and unemployment data. Other couple of things to look out for. Global democracy, there's yet another vote. Indonesia's voting, and it's the first time they've had a three-way opportunity rather than just a two-party thing for over 20 years. So good luck to them there. Hopefully they'll pick the right one. And then we've got Mr. Putin, a venture into a NATO country, which is what Turkey's classified as. Will it be him? Will it be one of his doppelgangers, his lookalikes? It's a chance to test it. Let's take him out. Should I be saying that? Well, I don't know. Let's jazz things up a little bit. And then that's the sort of week ahead. Good luck with it. Ramblings, the sort of things I've been writing down over the week, things I've heard. Some interesting stuff. Obviously, we've got the inflation figures, Europe and in the States. And it should eventually slow, but it's all about the pace of it now. Is it going to be lagging? Where is it persisting that it's just going to end up being at a higher level than before? I don't think we should worry about that. I think as long as it comes down and doesn't prevent the eventual rate normalization, that's fine. I've mentioned it before. We can live with that. And for some of the reasons I'll mention in a minute, there's a good reason for that. Stock investors are happy with a growth cycle. The bond market, are there any troubles there? Remember, rates were backing up on the supply issues going into that late October, November low. And so far, absolute slew of delivery supply side, particularly in the States. It's all being mopped up. Very little impact on yields. So therefore, very little to worry about. So, and there's another interesting argument. You might start to hear it. I've not really heard it before, but some people are saying that with the short-term interest rates being so high, that's creating some excess cash for investors that they're subsequently now investing into the markets. So part of normalization would just be to trim that down a little bit, make people come out completely of the lower end of the curve and get their money to work, do something with it. And that sounds sort of counterintuitive, but that would kind of act as a buffer for the economy because there'd be investment going in and it would kind of massage the timing of the reinvestment. So it's a good thing, another nice argument to add to the mix. But in the meantime, it's momentum versus fear, and then ultimately against the fear of missing out, which is effectively greed, isn't it? So nothing's really changed from all the old mantras, and momentum basically means that everyone's just giving up on thinking and just following. Again, you climb the wall of worry, we've seen off most things. Momentum's to the fore, and that's why we could drag up in those 3, 4, 5 waves, the ones and twos suddenly breaking out. People still going on about narrowing of leadership in stocks. Does it matter? Well, tech is outperforming in the US, mainly in Europe, in most of it in Asia as well. It's justified. People say, look at it. Meta's growth rate was absolutely mental. These things are throwing off cash left, right, and centre. ARM's update. Stock moved 48% on the day. Proper positive news. This is not like 1999 when people were talking about, oh, is the internet going to survive? No one actually had any earnings. These guys, not only have they got earnings, but they're growing. They're driving the momentum. It's up to other sectors to kind of catch up in a way. Europe itself, ASML, they're outperforming. Germany's S&P, which is enterprise software, massive demand for it along with the AI. These things are all there. These are now cash cows. Will it eventually pull things along? Well, we'll find out, but don't give up on and don't take on this stuff until you see some proper reasons to, proper cracks. Luxury, that had been written off for a while, and that's starting to perform. Definitely European updates were pretty good, apart from L'Oreal, struggling in China. But it's good news, net. Coming back to 4 cuts rather than 6 looks a little bit more balanced. And I put there, I check what they call the CME Fed watch tool. You can have a look at it. That's the one that they provide for free. Looks at someone asked the question how you look at the interest rates, and I'm trying to get access to some things for Europe and UK, but effectively you need to look at what the short-term 3-month interest rate futures are saying for all the way along the curve for the first couple of years until it goes into bonds, and then you can work out the percentage priced in for certain rate cuts, and you find the net average, and that's what the CME tool does. Warp on Bloomberg, if anyone has that, does the same, and that's the sort of thing. Bloomberg have got their own thing as well. And that's where, when you hear these, there's a X% chance of a rate cut, that's where they're coming from. So you can at least do the same thing for free on the CME Fed Watch tool online. And then I heard some good comments, people talking about, the emerging markets, and there's some people beginning to cut interest rates there. It could well be, even if the US goes into a pause, that some of the slack gets picked up by the underperforming places, and emerging market indices are beginning to break out. There was one being discussed this week that's broken through its 200-day moving average, despite having a 5% China proportion in there. So that's got rock bottom sentiment. There's every chance that bounces. It normally does at this time of year. Chinese New Year, it's the year of the dragon. Breathe some fire into it. I'm on fire now. I'm fuego. And it's still not bottomed out below the October 22 low. So, lots to be, lots to be positive about outside the US. And even if Europe and the UK aren't necessarily firing on all cylinders, we could suddenly get dragged along here. I've talked about what could happen if the dollar has this downside we're looking for. Then the commodity index breakout that's just beginning to look like it's happening on global commodity indices. That could easily carry on. That is, as I said there, the maximum bullish argument is that all happens. You've got the impulses in the indices on good tech data, and you've also got a cheaper dollar. Cheaper dollar helps tech anyway, as if it's based on lower interest rate expectations. That's earnings in the future being discounted by a lower rate. Bonds are fine. That'll help them. They're soaking up the supply. It's all there. What else can help inflation? Well, supply chains have normalized. We know about that. Immigration is actually helping net around the world, despite the fact that we've seen some wage increase data come out in the January numbers. But net they should offset, and we're still not back on the pre-pandemic trend. So these are all things coming from a low base. Nobody wants it to come back, and then you hear about the job losses. It's becoming, that's a low base as well for the growth. We can make a picture, as I've said before, of unemployment being worse. People are chopping. Some of the big companies now are chopping workforce down, using all sorts of excuses for reorganization to not actually admit what they're doing. And then last week we talked about the productivity increases. So net those two off, and inflation could well be controlled despite some near-term wage increases. So lots and lots of arguments for getting out of cash, putting your money to work. Playing that risk-free trade for the last 2 years has been great. You'll be able to park your money. And I've talked about the Greenspan put before, which is now known as a Fed put. That is basically having the option to cut rates to help when things get bad. That's been considered way out of the money for ages. But now, as in options parlance, when things are at strike, potential for it to happen, it's called at the money. And that is probably the Fed situation at the moment. If employment drops, we've heard about some of the officials now definitely looking at that, wanting to maintain full employment, then the Fed's waiting, but they can easily go. We've got to look out for any of the risks. There's bound to be pullbacks, but I think they are shallow pullbacks. Real estate, it's the anniversary of when things started going wrong, so people are nervous, but it very much looks like the Fed officials are on top of it. I'd like to see a rate cut again, just to take some of the pressure off those inverted yield curves. Let's make sure that the right companies are under pressure, and those are the ones we call the zombies, the ones that were kept alive by bailout funds. This is capitalist society system. We want to see the bad companies go bust and the money go to the doers, the achievers. The money flow should be where it is. And as someone said, I think it was on Friday, credit cycles, that is rising interest rates and how they unwind, do not mean that stock indices can't go up. We're seeing that. We're here. We still haven't had a rate cut. It's all about the potential timing. We've had 550 basis points of rates increased effectively across the major Western economies, and we still haven't had a mega recession. There's been no pain. That doesn't say that we're not just waiting for the lagged effect, but the market seems to have adjusted. The wall of worries there. What you start talking about now is it priced in? It's, keep your eye on it, because that's when people start getting complacent, blah, blah, blah. But for now, stick with, unless things go to shit with the inflation figures on Tuesday, I think we're into a very bullish phase. So talking heads for next week. There's quite a lot of speakers, not very many in Asia and Australasia. New Zealand Governor Orr speaks twice. Kohler of the RBA speaks once, and then it's really all about the main players. Bailey's got a couple of goes. Megan Green and Kathleen Mann, and Hugh Pill on Friday brings up the rear. There's a lot of officials, sort of speeches. It's not really going on Bloomberg or anything like that at the moment. It's places where they're actually making predetermined speeches. ECB's Lane has a couple of goes. Chairman and ECB Supervisory Boards there on Tuesday. De Quindos on Wednesday. Nagel's out. Lagarde has a go on Thursday. It's an economic committee in Brussels. Lane's back again Thursday, and Nagel as well. And then Schnabel turns up on Friday to round off the ECB week. Fed-wise, Bowman, Barkin and Kashkari starts off on Monday. Michael Barr's back and economic policy on Wednesday. Waller, that'll be interesting because he was the one that was definitely worried about the data and the CPI benchmarking referencing in his last speech. So let's see what he's got to say about last Friday. And then just a couple coming up in the rear on Friday. The diary is there for you to read. What I am saying there is just be careful. everyone talked about last week, things being in and out of certain diaries, and all I can say for sure is I don't quite know what's going on with what's being put forward as forecast, because I go to 5 or 6 different people to set up my diary, and some of the numbers for the big data points this week are all over the place and don't make a lot of sense. So treat them as a guideline, and anything important on the day, once I get a handle on it, I'll post something up on my chat for what we're looking for. Gerard will be banging stuff through on the institutional data, so just keep an eye on it. It's more that you know that the stuff's coming out, and be looking out for the bounces. It's mainly employment and wage data on Tuesday for the UK. Core CPI on Tuesday afternoon. Wednesday is the UK core CPI, PPI as well, and GDP for Europe and the States. There's not really much happening on Wednesday. It's crude oil inventories as usual. Japan GDP data Wednesday night, Thursday morning. Thursday GDP figures for the UK, core CPI in Europe, jobless claims, obviously usual stuff on Thursdays, but we've got Philly Fed and retail sales on Thursday as well. Friday, sorry, I mentioned earlier, I thought it was Friday. It's Thursday night for the Fed's balance sheet and the overseas ownership of US bonds. I don't think there's going to be much negative in that, given how, as I say, bond supply is being taken up. Core retail sales on Friday morning for UK. CPI for Europe for January. Then some more core PPI figures, the input prices for the US. And last month, Michigan caused a little blip up in the dollar when they brought their inflation expectations out. So just be aware that can still have an effect despite all the other data. So quite a busy week. Good look out there. I hope that's given you a few pointers on some of the things to look at. It's not always about the most obvious stuff you see in there, and it's about what's creating the mindset for people to want to invest rather than looking to sell, where people say all-time highs and there's no breadth and there's none of this. If you're not careful, what happens is things catch up. It'll be all normalizing. You've been waiting to buy the dip. There is no dip. Be careful. Be careful both ways. Find your ranges, but I'd say I'm looking for upside unless anything really changes on Tuesday. Good luck out there. Cheers.